Hello, in this video I will show you 5 simple ways how to effectively use fixed range volume profile on TradingView. Fixed range volume profile is a very powerful indicator, but you need to know how to use this indicator correctly, and that's why I'm making this video. So in this video I will show you these 5 methods how you can use this powerful indicator, and then I will show you very powerful order flow entry confirmation, so thanks to that you will get the best setups as possible. All of that will be in this video. So if you are ready, prepare your notes and let's get started, shall we? First, let's look at the settings and what the fixed range volume profile actually does. If you are not interested in settings, you can skip straight to strategies. The video is divided into chapters. Thanks to this indicator, you can measure specific sections on the chart that you choose and identify the trading volumes at different price levels. This is a great tool because it allows you to see where the highest volume was traded in key areas of the chart, or for example, which side was dominant at those specific levels. Let's say you have an important key range and you want to see exactly where the highest volume was traded within that section. By using the fixed range volume profile, you can get exact, precise volume levels of that important range, and you can use these areas for your potential setups. For example, once I measure a specific section, the tool displays the volume area high, volume area low, and the POC point of control for that range, along with specific volume traded at each price level. When I double-click on that indicator, I'll get access to its settings. The first step is Inputs, where you will find the row size setting. This determines the clarity of the profile. The higher the number, the more detail you will see in the volume profile. Personally, I use 90. Next is Volume. This determines the type of volume data the profile will plot for you. I use delta because, in addition to the total volume at a given level, it also shows me which side was more aggressive at a given level. And volume area volume determines what percentage of the total volume will make up the volume area. The most commonly used setting is 70, so leave it as it is. In the tab Style, you will set up the colors of the profile. Personally, I would customize the colors for buyers and sellers, specifically the up and down volume. Also, don't forget to enable the volume area high, volume area low, and the POC point of control, as these are most crucial levels of the profile. You can leave developing POC and developing volume area disabled, as they aren't essential for the setups I will show you in this video. And that's all for settings. Now let's take a look at the first way how to use this powerful indicator. The first highly effective method is measuring swing points, from swing high to swing low and vice versa. This is great to use in trending markets, where there is clear direction of price. Why? Because it helps you identify strong zones that you can use as a point of interest for entries during a pullback. Essentially, what you do is that you switch to a higher time frame, for example 1 hour, 4 hour, or even daily, and you measure the latest swing. POC, volume area high, and volume area low work great as the levels where the price can reverse and continue with the trend. In strong downtrend, you measure from swing high to swing low. In this case, volume area high, POC, and volume area low act as resistance, and you can mark these zones as your potential point of interest where you will look for sell opportunities. In uptrend, you measure the swing from swing low to swing high. In this case, volume area high, POC, and volume area low serve as the support zones where you can look for long entries on lower timeframes. If you are not sure exactly where swing starts and ends, you can use other TradingView indicators to mark the swings for you, and then you simply measure them. Biggest mistake is that traders measure swings on lower timeframes. This is completely wrong because on lower timeframes there is a lot of noise. So by measuring swings on higher time frames, you will get clear, precise zones where you can look for entries on lower time frames. The ideal entry could be, for example, break of structure, fair value gaps, or my favorite one is absorption. In short, you are looking for liquidity sweep above swing highs or below swing lows on a lower time frame, right within the vol area low, POC or vol area high zones from the higher time frame. In the uptrend, you are looking for bearish absorption in these zones. And in a downtrend, you are looking for bullish absorption in these zones. So absorption in a vol area high, vol area low or POC zones is the final confirmation before an entry. I made a separate video on this channel about absorption, which is very powerful and precise order flow pattern for determining price direction. The whole video is packed with live examples and full of volume. I'll leave you link somewhere up here. Perfect. Let's move to next strategy of this video, and the second strategy of this video is called range-based profile. In other words, consolidation. As the name suggests, here we will be measuring non-trending markets, also known as consolidations. Once again, the higher time frame is your foundation. Believe me, the higher time frame will give you clarity and clean perspective on the market. The range we are looking for and the one we will measure with a fixed range volume profile looks like this. It consists of equal highs and equal lows at a similar price level. The price is essentially playing ping pong between them. Very important in this case, the way we use POC, volume area high and volume area low, will be slightly different compared to the previous strategy. Here we use volume area high and volume area low as our primary points of interest. Volume area high serves as the ideal zone for short entries on lower time frames, while volume area low acts as a zone for long entries. The POC then serves as the level where we take profits, because in this situation the POC acts as a magnet for the price, around which the market consolidates. You may ask, what is the logic behind this? When the market is in consolidation, it means it has found balance. Anything above the volume area high is considered expensive, overvalued. Buyers aren't interested there, but sellers are. Because there isn't enough buying power but plenty of selling pressure, the price quickly rotates back to POC. The POC is where the interest is highest, both sides are in equilibrium, and the most trading activity occurs. The same applies to volume area low. Anything below it is considered cheap, undervalued, so people don't want to sell there. On the contrary, they are looking to buy. Because logically, who wants to buy for expensive and who wants to sell for cheap? Nobody. Everyone wants to buy for cheap and sell for expensive. That's why volume area low is a great point for potential longs, because there is a lot of buying pressure, and volume area high is great for shorts because there is a lot of selling pressure. Once again, you can use the absorption concept same as with the previous strategy. So in the volume area low levels, you can search for bearish absorption, and in a volume area high, you can search for bullish absorption, and the POC will be your take profit level. Here is an example of a long setup using this strategy. We can see that the price is currently below the volume area low of this range, making it ideal spot for longs. A valid absorption occurred at the market levels, allowing us to enter long position with a take profit target at the POC of this range. And that brings us to our third strategy, the range breakout. The price can't stay in balance forever. As soon as there is massive selling pressure or buying pressure, or if there is a lack of liquidity on one of the sides, the market simply breaks out of the range to test lower or higher levels. and that's what's called range breakout. Essentially, what we are looking for is a range followed by an impulsive move either to the upside or downside. This is the section we were going to measure. The profile will show us the volume within the range, but also the volume of the impulsive move. And what we want to trade are the low volume node zones or high volume node zones with the absorbed volume. I will explain to you what that means in a minute. Once again, the foundation of this strategy is high time frame range with impulsive breakout. It's crucial here to have your fixed range volume profile set to delta. This allows you to see the exact volume imbalance and the aggressive buying or selling activity. I'll measure the range along with the impulsive breakout, focusing on two types of zones. The first is a low volume node, where the price returns to fill the gap. Again, I monitor this zone on lower time frame, like the 5-minute chart for example, and wait for absorption. If that occurs, I enter the position as I'm expecting a bounce back to direction of the breakout. The second type is the absorption zone. On the volume profile, an absorption zone is an area with high volume that was not respected, and the price moved right through it. This indicates that one side was completely overwhelmed by other. In practice, it works like this. During a downward breakout, this zone contains heavy bullish volumes. Those buyers were never rewarded, and as the price returns to their entry levels, they will want to close their positions at break-even. This creates selling pressure because closing a long position requires a sell order. That's why this zone is excellent for short setups. Once again, you can drop to a lower time frame and look for absorptions within that zones. If we see an upside breakout, we look for zones with heavy bearish volume. This will act as a support because during a pullback, these short sellers are highly likely to close their positions, which trigger buying pressure. Essentially, their buyback orders provide the fuel for the next leg up. This is exactly why I want to monitor for absorption in these zones and enter long positions. We are essentially waiting for the market to prove that the sellers are exhausted before we ride the next wave up. Our next strategy involves measuring sections with high delta or high volume. To do this, you will need a volume indicator that highlights these specific areas. But why it's so important to measure sections with massive delta or volume? It's because areas of high volume represent areas of high interest. That's where big money is. And when you know where the significant capital is positioned, there's very high probability that the price will react to this volume. By measuring these high volume sections, you get a breakdown of exactly how that volume is distributed across specific price levels, giving you precise entries. Unlike the previous strategies, here we measure the sections directly on lower execution timeframes. This means you can actually use limit orders as soon as the price pulls back to these zones. Based on my personal experience, if you see absorbed volume, high absorbed volume within that profile, those are the best levels to enter from. As I mentioned, I covered this topic in my absorption video, so be sure to watch it. The POC, volume area high and volume area low, serve as ideal entry levels, with your stop loss placed safely above or below the profile. You can even split your order into two. One entry at the POC and other at either the volume area high or at the volume area low, depending on the direction of your trade. This allows you to get a better average entry price while managing your risk. These volume sections often form after macroeconomics announcements. the volume ratio is so extreme that these levels can be 10 times larger than is the average. That's why I view them as incredibly strong and reliable. They represent a massive concentration of capital that the market simply cannot ignore. And the last highly effective way to use the fixed range volume profile is to measure rapid sell-offs or buying pumps. More specifically, these large pumps or dumps. When a major impulse occurs, I want to see how the volume was distributed. If the volume during a pump is concentrated mainly in the lower section of that pump, I expect a return to the volume area of that leg, followed by a bounce higher, so ideal zone for longs. If the volume is clustered at the top of the leg, I anticipate stagnation and move to the downside. However, if the volume is distributed evenly across the entire leg, the market is likely to enter a period of balance and sideways consolidation. When volume is at the bottom of the move, it means that the big players entered early and they are defending the base of the pump, which makes the trend very healthy. On the other hand, volume at the top often indicates late buyers jumping in due to FOMO. There's no one left to push the price higher, so we expect a reversal or distribution phase. Even distribution means the move has already found its fair price. The excitement is over and the market is happy to chop sideways in a new range. And same applies for the dump. If I see bearish volumes or overall volumes distributed in the top of the bearish leg, bearish impulsive leg, it means a healthy bearish downtrend and we can expect bounce from these volumes to the downside. On the other hand, if I see volumes at the bottom of the bearish leg, it indicates exhaustion and we can expect some sort of accumulation and reversal to the upside. And when we see evenly distributed volumes across the entire leg, across the entire impulsive leg, there will be most likely some sort of consolidation. So, in an impulsive pump, my personal strategy is to trade bounces off of the volume area for a continuation higher, or to play distribution phase for move back down. I usually measure these impulses on higher time frame, and for precise entry, I use absorption on lower time frames. If I want to enter blindly without absorption, I can measure these impulsive pumps on lower time frames where I will enter on limit orders. During a dump, I focus on two scenarios. First, a bounce off of the volume area in the upper section for continuation to the downside, confirmed by absorption on a lower time frame. Alternatively, I look for bounce in the lower section for move to the upside. Again, waiting for that lower timeframe absorption to confirm that reversal. And if I want to trade without low timeframe confirmation and without absorption, I can simply measure these dumps on a lower timeframe and enter on limit orders. And that's basically everything from this video. I hope that this video helped you at least a bit and that you found that you were looking for. However, it's crucial for you to understand absorption in order to understand these strategies from this video, because absorption is very powerful order flow trading strategy which will help you filter out the best setups as possible. So if you want to continue learning, I'll see you in this video. Also, don't forget to support this channel by liking this video and subscribing this channel.